Thank you guys for joining today's webinar. Today's webinar is going to be a little bit different than other presentations that I've hosted. We typically focus a lot on down payment assistance programs. Today, we want to focus more into like the roadmap of you buying a home in today's market, especially, with housing prices, interest rates. A lot of my clients call me and they question me, am I ever going to become a homeowner? And my answer to them is yes. And this is why we continue to do these webinars. So we'll get started. Let me turn right in here. All right. If you have been in my webinar before, thank you guys for returning. And this is your first time. My name is Luz Lluncor. I am the branch manager at New World Mortgage here in the city of Downey. We service all over California. We are a DBA of American Pacific Mortgage. They are based out in Sacramento area. So we do lend and multi-states all across the United States. So if you need a loan outside of California, we're more than welcome to help you, but we do finance from north to south of California. So, some of the questions that people ask, if, I'm in Sacramento, can we still obtain your loan with you? And the answer is yes. This is my 26th year in the industry. And, when I started in the late 90s, the industry was very different. Right? Home prices were about $100,000, but interest rates were about 13 to 14%. So equivalent to from 90s to now, people were paying, $150,000 home to a mortgage interest rate was equivalent to about a $300,000 property. So a lot has changed in the industry. And I think through my experience, we do see it's a little bit, more challenging for first-time buyers to become homeowners and, going back to affordability, price, interest rate, all of that comes together. But it is not impossible for you to become a homeowner. It just takes a little bit of patience, strategies, the want, the desire to become a homeowner. And there are a lot of great programs out there for you. We focus on first-time buyers. We do, of course, do a lot of investment loans, second mortgage, different types of qualified, unqualified mortgages as well, refinances, line of credit. But I want to say about 90% of our business is helping first-time buyers get into home loans. I am CalHFA Preferred Loan Officer, and what that means is we just close a lot of different down payment assistance programs, and we go through trainings with them, so we have a great knowledge on how those programs work. I am also a certified coach by Freddie Mac, which allows me to host different boot camps and educate the community about not just homeownership and programs, but also on affordability, budgeting, tapping into home insurances, closing costs, and then overall, what do you need to become a homeowner, which we'll cover that towards the end as well. All right, and I do have a full service team that works with me. We're about 3 of us here at our branch, so I'm not alone. So in case you submit an email to us, one of my members of my team will get back to you as soon as possible. All right, so how many of you guys, I want to start with this question, is how many of you guys think that you need 20% to down payment to buy a home? Can you guys just put that in the chat? I kind of want to hear from you guys. That's kind of like the myth. Everyone thinks, without 20%, it's impossible to buy my home. Thank you guys for participating. Well, today we're going to find out that no, you don't need 20% to buy a home. I just got off the phone with a client that was actually shocked, saying I only need, $8,000 to buy my property. And, the answer was yes. Right. And this is why you're here, to find out how are people buying homes without a large down payment and still have affordable mortgages. Okay. So you don't need 20% to buy a home. All right. And, these are some of the myths that people are, hearing out there, and everyone that I have a conversation with, it's constantly saying, I hear this from friends, from family. I talk to people and this is what they told me. So, everybody has a different story and everybody had a different experience as well when they became homeowners, right? And I honestly want to say that the best experience you're going to have when it comes to buying, not just searching for the property, but also the financing, is when you come through these workshops. I often find that my clients who participate in these workshops, also with my realtors, the process it's easier. You already have a lot of the questions answered. And then sometimes in 30 minutes is just not enough to cover a lot of information when it comes to financing, okay? So you don't need perfect credit to buy a home. You don't need 20% of a down payment to purchase a property. And you can never make too much money to qualify a home, right? That's another thing where a lot of people say, I make too much money, I don't qualify for these programs. That is also a myth, right? And one of the things that people are constantly are talking about, and we've been on this conversation for 4 years now, okay? So if you've been following mortgage rates, we've been kind of the same pace for over 4 years now. Nothing has really changed. Of course, the pandemic brought amazing interest rates that I don't know if we'll ever see them again historically. In 26 years, I've never seen those rates. In the future, I don't know. But if you look back historically for 4 years, we were about 7% a couple of years ago. It is slightly better. Of course, we like to see mid fives. But 6% to 6.5%, it's kind of been the norm for quite some time. So if we are waiting for that to drop, we are going to wait forever and never become a homeowner. So don't let rates discourage you from buying a home, okay? Because you can always refinance when they drop. All right. So let's dive into what lenders look at when you're buying a home. And again, if you guys have any questions as I go through the presentation, feel free to just put it in the chat. I will get to everyone's question at the end of the presentation, okay? So what do lenders look at, right? Of course, to buy a home, you need to have income. You need to work, right? You cannot buy a home without verifying your income. You can buy a home without credit. This is why I put income as my number one thing. So you definitely need income. We need to be able to verify that you're working to be able to obtain a home loan. You need credit, right? But there's some loans that you don't necessarily need a FICO score. But credit, it's another thing that the banks look at. Employment, the type of job that you have, the history you have in the employment, what are some compensating factors that is going to strike the file? This is what the banks are looking at. Down payment, they want to see where the down payment's coming from. It can come from you, donor, it can come from your employer, it can come from your retirement account, and then it could also come from a down payment assistance program. So all those things are factoring in and how we underwrite and approve loans. They're looking at your monthly budget as well. So your monthly budget is your debt to income ratios. So they are not looking at your bank accounts to see what you're spending. So don't worry, we're not going to be reviewing that. We're looking at bank accounts to see, the deposits. If you have reserves, you have extra income in there. Sometimes, we look at bank statements and we spot like a different income that the client didn't disclose to us. And we'll ask the questions and we'll ask, hey, what's this mean? Where does this income come from? And often we are surprised that they forget to disclose to us, I have a second job, or I have Social Security income, or I'm getting, retirement money. So this is why those bank statements are really important for us to review, because when we underwrite your files, we want to look at all these factors, okay? All right. So, looking back into buying, again, the med's about 20% down payment. Let's get that out of our way. We don't need it, okay? Factors on what you need to purchase, it's really important. And one of the things that I get upset about right now with social media, they're telling people that buying, it's not a good thing. I don't know where these TikTok videos are coming from, but buying it is absolutely the best thing you can do. If you're renting, you don't want to rent forever. And I understand that sometimes giving up our rentals from areas that we love to live and buying in areas that perhaps is not really the number one preference for us, it's not ideal, but buying in real estate means that your money, it's not going to waste. You're building equity. You are going to use that money in the future to pay off debt, education loans, buy another property. There's so many advantages into buying. So you're also going to have, these are some of the just top like 4 things when it comes to buying, why it makes sense. One is that property taxes and mortgage interest are 100% tax deductible. So if you're in a high tax bracket and you're paying the IRS a lot of money and you have nothing to write off, well, buying a home is going to be, a great investment. You're earning equity as you have your home. So keep that in mind, right? There's equity that You're earning, the more you pay towards your mortgage, the lower the balance. Properties appreciate anywhere from 2 to 3%, depending on the area. Some areas already reached their max. That's when talking to a real estate agent makes sense, right? So they can advise you where is the right area to purchase, where you still can earn the max of equity per year versus buying in an area that's already capped out on equity. So those things are great questions to ask your realtor when you start looking for a home. Control your own improvements, right? How many of you guys are renting and you want to change something and you think about it twice because you're improving somebody else's property and not yours? Or if you have a landlord that's not doing the work and they're still expecting you to pay rent, right? So those are the great advantages of you owning a home, is that it is yours. It is something to be proud of. You can earn equity on it. You're paying down your balances. You're no longer paying somebody else's mortgage. You're paying your own mortgage and you're building your own equity. So definitely buying, it is a great investment. Okay, renting, it's not tax deductible. You don't earn any equity. You cannot make any improvements on the property. And really, when you're renting, you can't make any changes to the house. And some of these rents are asking, at a client that applied for rent, and they're asking her for like 3 months deposit, excellent credit. They want to see the income. At that point, you're better off purchasing than you are renting. So definitely it's still a great investment to purchase. All right. So we're going to talk a little bit about the benefits of down payment assistance programs. Down payment assistance programs, it's going to help you reduce upfront costs, okay? And we'll kind of tap into that a little bit as we go. It also makes homeownership achievable faster than waiting to save up more funds. And there's also great benefits to low to moderate income buyers, okay? So now, there are different programs that have income limits, and each program has its own criteria, but that doesn't mean that you can't qualify. Sometimes you read the word low to moderate income and you look at that income limit and automatically you assume that you don't qualify for these loans. That is not correct, right? They just have different categories on interest rates that they promote for families that do make lower income than other families, but that doesn't mean you don't qualify for a home. Okay, it also frees up your savings. Excuse me for the typo there, I forgot one letter. So if you have, your own money to buy your home, and this is one of the things that I hear a lot in my conversations with clients, is emergency funds. People are concerned and they want to keep emergency funds. They don't want to exhaust all their savings into buying a home and stay with no money, okay? And as you know, when you buy a home, there's a lot of expenses are related to the purchase, not just your down payment, but you also have your closing costs. So participating in down payment assistance program, it gives you the ability to, one, buy a home quicker, not wait to save forever for those funds. Two, keep some of the money that you do have at home for emergency reasons, maybe catching up with the debt, paying off debt, mortgage payments, or, remodeling the property. There's a lot of advantages of down payment assistance programs. And then if you do have your own money, in addition to that, we add another 3% or 5%, whatever that looks like, you're starting to build equity a lot quicker. That means your loan balance is less, so your monthly payment will be less as well. So a lot of advantages of combining down payment assistance programs, even though if you have your own funds. Here are some different types of down payment assistance program. And one of the things that a lot of people promote online or different workshops or different lives is they don't give you the fine print on these programs. They just talk about how great they are, but they don't talk about how expensive some of these programs may be. And there's different types of down payment assistance. And we're going to start with the grants. Okay, grants are not repayable funds. They're there to assist you with down payments. There are no strings attached to some of these programs, so you have to be careful. Some grant programs do have some attachments to the property that you cannot sell it with a certain period of time. Some grants as well come with a combination of a loan, and that makes that mortgage more expensive because to be eligible for the grant, you have to participate with the loan. and some of these loans are repayable. Okay, so different types of down payment assistance, grants. Then there's the loans or go towards the down payment. They are forgivable loans as well. So then some down payment assistance program that after you live there for 5 years, they're forgivable, so you don't have to repay them back. They're also deferred second loans. A program like CalHFA, down payment assistance program, those are deferred loans. They give you the assistance to purchase your home with 100% financing. That means you don't need a down payment. Now you could also put in your own down payment. In addition to that, receive funds. Those would be deferred loans. That means you're not going to see the repayment of that loan in your mortgage payment. And there's also gifts. Some programs sometimes have gifts. I know we have some programs that you may be eligible that will give you some gifts. Employers are also gifting people money to buy their home. Your family members can gift you the down payment on different types of loans. There's certain requirements, but there is no maximum of gift that you can receive from a family member. Okay, so these are different types of down payment assistance available, and every single one of them is going to have, small print. So we have to make sure is each program the correct program for you. And once you apply, we'll definitely go through those scenarios, and if there's a confusion, I'll clear that up for you, and then we can, go into the website and we can look at it together to see if it's the right program that you're looking for and if it's your needs as far as your mortgages. Interest rate, when it comes to interest rate, people always ask me, what's the best rate, Luz? Am I getting the best rate? Or why am I getting this rate? Why do I see this rate? How does rates work? A lot of questions when it comes to rate. And then, of course, online, you see different rates being quoted on Zillow, Quickens, Redfin, you name it. Every platform has a rate. What they don't talk about is the factors on what changes the interest rate when you shop with the lender. So often clients are looking for the best terms available, as you should, but a lot of times lenders don't explain to the clients why they're receiving the interest rate they are. A lot of it thinks it's just online, you're clicking on things and you're getting a quote, or you're calling someone, giving them over the phone information and you're getting a quote. A lot of factors are coming in with interest rate. Loan program, the amount of down payment, loan terms, credit score matters. Okay, it's that other family member receive a lower rate because we're paying fees to lower the interest rate. So those are all different questions you should ask all the time. Why am I getting that rate? A lot of the down payment assistance programs, their rates are posted daily online. So you can go online and just Google daily rates. Whatever rate you see with the down payment assistance programs by state agencies, that is the public interest rate. What you see is what we provide to you. There's no change on that. Okay, so you can shop with other lenders for down payment assistance program. They should all be quoting you the same rate. No one should be changing that unless you're buying down the interest rate, and then you'll have a different quote. Okay, so is it worth paying fees to lower your interest rate? It depends. It depends how quickly you're going to make your investment back. If you are paying $4,000 or $5,000 in fees to save $50, if you ask me, I would say no, don't pay us the fee to save $50 a month. It would take you 5 to 6 years before your investment is returned to you just because you want to see your payment $50 less. My recommendation, keep that money, put it in an interest-bearing account, or do any remodeling to your home, save it for a rainy day, and just don't pay the bank, $3,000 or $4,000 in fees just to see your monthly payment drop by $30 or $50. Now, if the rates allow us to make adjustment in buying down, interest rates make sense to you, and you're saving over $150 a month, then yes, do it, because then that's a significant difference. So we'll run those scenarios to see if it's worth it for you. And then we can make the decision. You don't need to worry about rates until you're actually shopping for a home and you're estimating to buy in the next 30 to 90 days. We can kind of give you an idea what rates have been doing in the last quarter. If you're about a year from today and you're not ready yet, I would not worry on what rates are going to be like in a year from now. Okay, because that changes quickly. And sometimes, we've been the same, for quite some time. So we may be looking at 6.5 rates next year as well. Okay, so how to qualify for a home loan now that we talked a little bit about, some down payment assistance, underwriting credit limits. What do you need to qualify for a home loan? Most important part, remember we talked about income, but also credit matters, okay? So some of the qualifying credit minimums for these programs are going to be 580. It's going to be for traditional FHA loans, 620 for conventional, 580 for VA, 640 to 680 for some of CalHFA programs. So those are going to vary. Some of the credit score factors are going to be based on, credit history. So sometimes our FICO scores are like 680 and our systems are not approving the credit. And that's because too many judgments, maybe charge-offs, liens are impacting the credit. Maybe limited credit can impact the decision of underwriting. Too many authorized credit cards. So, if you're an authorized user on like 6 credit cards and you only have 1 trade line and your FICO scores are based on everyone else's credit, that might also be part of the decision making on their underwriting system. All the files go through an automated underwrite. Okay, so everything goes from the automated underwriting system. With AI, all the banks are using, technology more than ever. They're also making decisions on pre-approvals now, which I love and hate. I love it because it makes my job a little easier, but I hate it because they don't really see all the details sometimes that we look at as we flip through the pages on the documents that we receive from our clients. So you still need a loan consultant to guide you and actually look at documentation still to make sure that we're making those final numbers and decisions as well. So credit's going to matter. So, and that's also another thing is that credit score is also going to factor in the interest rate you receive and also the program that you're qualified for. The great benefit on credit is that no matter where you're at in this category, there's going to be an opportunity for you, your friends, or your family to get into homes. Maybe a little bit different, but the opportunities there, even including with down payment assistance programs. Here are some of the factors when we look at credit, and this is something that I always like to share with my clients, and that way you can review your credit. If you have Credit Karma, you should see an example like this and how your credit's being impacted by different criteria. So the biggest way, payment history, it's about 35% of your credit score. So try to keep everything on auto pay. Make sure that you are not late on anything, because if you're late on anything in the last 12 months, that drops your FICO score significant. And it's just, sometimes you can pay down everything else on your credit report and it will not change your FICO score, because that one late, it's going to linger and impact your FICO score for quite some time. So take a look at your credit, make sure you're not skipping any payments, put everything on auto pay as you prepare to become a homeowner, just in case something happens. We don't want the credit score to be ruined. Now, I want to say in 26 years doing financing, super, proud that credit has improved overall with consumers. The credit scores now are higher. I think in early 2000s, a lot of the credit scores were like 640, 680. Now we're starting to see, our credit scores, over 700 more often. So we, a lot of, I think, technology and social media and, the internet has really helped consumers and educate them on what are the things that are impacting their credit. 30% of it, it's also on the amount that you're owed. So you want to make sure that you are not, you drop your balances as well. 20%, it's on in-used and used credit. And of course, 50%, it's on the length of credit. Types of income that we need to help you qualify, it's going to be 2 years of employment history. You don't have to be in the same line of work. You can count your school as your job history. So if you just graduated from college and you get a job offer next day, that can complete your job history. So you don't need to have a 2-year job history exactly. If you have a part-time job, 18 months minimum is a requirement for your part-time job before we can use it. Okay, sometimes 16 months, but no shorter than that. Gaps between employment, it will be case to case, but about 6 months with a good letter of explanation is acceptable. If you own a business, we're also going to need your business tax returns. Assets, so we want to verify where the money is coming from for your down payment. It can be from your bank accounts, from your IRA, from 401k loans. It can be in stocks. It can be gifts. So these are just some examples of where the down payment can be sourced from. If I didn't cover something that it's different, just reach out to me and I will make sure I give you an answer for that. Types of loans, there are conventional loans, government loans, which are your FHA loans. All these loans are first-time buyer programs. So a lot of conventional loans are being used depending on credit score, government loans depending on credit and also type of property. And then, of course, your conforming and your jumbo loans are different. First-time buyer have different programs, grant programs, loan programs. This can be another hour of just training on different types of programs. So we're just gonna lightly cover on different types of products out there. But the majority of first-time buyers are participating on conventional or FHA loans. There's a difference also between a fixed rate and an adjustable rate. Very few clients are doing adjustables, but 5-year adjustable rates are becoming a little bit more popular now, just to keep those mortgage payments low. Okay. Buy down options are also available for down payment assistance programs. So that's also another option if you want to start with the lower monthly payment the first couple of years and then gradually scale up to a higher mortgage, which is a great idea for a lot of people that are in a tight budget. What's included in your mortgage payment? You're gonna pay your principal and interest, your taxes, your insurance, and also your PMI. Unless you have 20% down payment, you don't have a PMI included in that mortgage. Conventional loans have different PMI factors. So remember when we talked about credit score and debt to income ratios, which means your income, it's going to matter. So the PMI factor is going to kick in depending on what your credit score is. Also to whether your debt to income ratios are lower than than usual. All those things are going to determine the PMI on your loan on a conventional loan. On an FHA loan, the PMI factor is the same across the border, no matter whether you give us 20 or 30% on an FHA loan. So first time home buyer assistance program come, like I mentioned earlier, from different entities. It can be different states. It can come from cities. It can come from county. It can come from federal, right? So the Dream for All program was money funded by the government and to CalHFA, which is the state agency for the state of California. And they are the ones who are, they took the funds and they're the ones who are distributing towards a lottery, which happened in April for the Dream for All. So will that program come back? We don't know. If it does, it comes from the feds and into us. These are some of the eligibility for the down payment assistance. CalHFA, offers the program with the 640 credit score, conventional 680. There's a max debt to income ratio of 50%, only if you have a 700 credit score. Income limits are also super favorable for these programs, but you could only purchase the property single family, manufactured, or a condominium or a townhome. CalHFA does not lend on the duplex. However, my platinum program here, this one, it is open for a duplex and also for non-owner occupied. The platinum programs typically, the grant programs benefits nurses, teachers, and first responders. But this month, all the way to August, it's open to everybody. So if you want information on that combination of grant and loan, let me know. We can definitely send that information over to you. All right. Here are just some program limits for CalHFA. So that doesn't mean you need to make $214,000. All it means you can make up to $214,000. And then Orange County, Riverside, San Bernardino, and San Diego. If you are in different counties, you can access all the loan limits direct into CalHFA's website. All right, so there's a lot of information that we need to cover and webinars, and we get a lot of questions often. We've been hosting this for years, and I get a lot of people attending them, which is great. Thank you for being here. And after we do the approval and after we run some numbers, we still have a lot of questions about the whole buying process. So with that being said, what I'm going to do starting in the month of August is I'm going to do a 3-series boot camp for those who are interested, and to dive in more into details on what the whole buying process looks like. Okay, from credit review, from estimates, closing documents. And estimates is really important because banks send out estimates to clients. I send out estimates to clients, and you're reading and you're looking at your monthly payment, and then you're looking at what the total cash to close means. But everything else is so confusing. So in this boot camp, we're going to go over estimates, what it's included in there, your impounded account, what does that mean? Who pays my taxes? What does homeowner insurance mean? So we're going to be covering all that information. We're going to be covering PMI on specific loans. We're going to talk about home search and your affordability, what offers look like and how offers are being treated in today's market. We're also going to talk about escrow because first thing the agent says, congratulations, you won the property and you're going to open escrow. And everyone asks me, Luz, what is escrow? Right? So we're going to talk about the role of escrow, the loan process, inspections, appraisals, termite, home warranties. A lot of times clients ask me, I want to buy, but I'm afraid of buying because I don't have money for future repairs. Well, people don't know there's a home warranty in your contract. So we're going to cover a lot of information because as a homeowner, you should know all these things besides program and what you qualify for, right? You should know what every step of the way, how contracts work, what to expect, and once you learn all of this, I feel that my clients are more prepared. They're not scared to proceed with the purchase. And it makes the process a lot easier. So whether you're 3 months, 6 months, or a year away from purchasing, gathering information and learning on how easy it is for you to be able to obtain a home, it's wonderful, right? I encourage everyone to attend. So if you are interested in attending, you can send me an email. Let me know, Luz, I want to attend. And I would be more than happy to register you in the month of August for these boot camps. All right. I know there's a lot of information we covered, and it's hard for me to, go in depth with a lot of info. I'm going to answer some of the questions that came up today. One of the questions is for self-employed, do you need to have 2 years of income for the tax return and then a current monthly payment history? So if you're self-employed and you just started your business, you do need 2 years, okay? If you're self-employed and you've had your business for the last 5 years and you have a 10% down payment, we only need 1 year. If you don't qualify because your taxes don't report everything as you should, based on what you need to purchase, we have non-traditional financing for self-employed clients. Okay. So CalHFA, another question is that is financing through CalHFA more strict with other lenders? So CalHFA has their guidelines online. Okay. CalHFA is just a state agency that's giving you the down payment towards the mortgage. The lenders are the one underwriting the files. So CalHFA doesn't look at your files. They just look at what we input in their information and provide us the funds. So CalHFA is not underwriting any files. We're making that decision ourselves. And in comparison with other lenders, I don't know. I can't speak for other lenders if they have experience with working with CalHFA loans, they have experience with debt to income ratios, how much experience they have evaluating a profile of a client's loan. That really makes a difference. I started, years ago, and being new in the business, I had a mentor that had, over 2 decades of experience in the industry. And that really helped me as a new loan originator to, overcome a lot of barriers, to overcome a lot of mistakes, as a lot of new loan officers do in the beginning. So one of the things that I do recommend my clients, and I don't want to say that someone new doesn't have the experience because I was new one day, is that just to, make sure that you're working with someone that knows how to work properly these loans, and also can guide you and structure different options in financing. I think, having different options is also going to help you negotiate better contracts, right? It's because there's not one loan that you're eligible for. So if you're eligible for one loan, you're probably eligible for 3 or 4 different options. So you want to inquire about those options you have and just keep them in mind, just in case, there's something that comes up and an opportunity, you're going to be ready sooner than later. All right. Another question, I was told bank statements are looked at and you're looking at how they're spending your money. You're saying that's not correct. No, that is not correct. The only thing that we, and I want to mention this and not to, scare anyone, but in the bank statements, we're not looking on your, what you spend your money in. We're looking at large deposits to see if any of the money that you're using comes from cash, because that's not acceptable. Another thing that people don't know that banks do look on activities, how you spend your money, is Disneyland passes. If you buy Disneyland, Universal, or any passes, and you're in the 12-month installment plan, well, Disney does not report that in your credit. However, the bank looks at that as a credit installment payment. So they will take a look at that and use it as your obligation. Apple Pay, these new ways of 12 payment plans when you're purchasing, large things, they're saying that's not impacting your credit, but we're seeing those withdrawals coming out of your bank statement. So we see too many consistent. We're going to ask you, in order for us not to include it in your monthly payment, we're just going to ask you to pay it off, which I have. So I've had clients that bought Disney passes, and it was a lot of Disney passes. It was a big installment payment monthly. I just asked them to pay it off so they can qualify for more. So that would be, I think, the only thing that we've seen. We haven't, and it's rare. Again, it's really rare that we see that. It's not every bank account, but that's all we're really looking for in primarily activities for large deposits. I personally look at bank accounts to see if I see any source of income in there that my clients didn't mention to me, because my job is to look through these bank statements to make sure that I can count every dollar possible and give you the opportunity to qualify for more. Okay, but we're not looking at your expenses as a debt as a whole. Can we pay our mortgage faster than 15-30 years? Yes, you can. We don't have any loans at prepayment penalties on government and Fannie products. Maybe other programs they do, but not these state programs. So you can pay it off at any time. If CalHFA programs have more strict requirements, what are the benefits of using versus conventional? So the CalHFA doesn't have stricter requirements. The only thing that CalHFA does have is a maximum debt to income ratio on the programs based on your credit score, right? Now, the great thing about CalHFA is that if you have a 640 credit score, for example, the interest rate, whether you have a 640 or 720, it's the same across the border for everyone, which I love, versus conventional or FHA. They do factor in your FICO score and your pricing may be higher. And this is why sometimes CalHFA programs for me is the outlet for my consumer, because that it's the best option I have available for them when it comes to terms. And also they get a down payment assistant and they get an awesome interest rate. So it's stricter, and only if you have a lower FICO score and you want a higher debt to income ratio, then yes, CalHFA does have a maximum under DTI. But all the requirements, all the guidelines are all the same in CalHFA loans, whether you buy FHA or conventional loan. Okay. Does child care count as a debt? So no, only if you are paying child support as an obligation, but not childcare debt. Okay, so what if a family member pays me for caring for a family member via sale? Does that count as income? No, unless it's reported or it's IHSS income. So if it is another type of income, then that it's been reported on your taxes, then we can count it. Now, on conventional loans, we do have boarding income allowed. So if you have someone that's lived with you for quite some time and you have proof that they've been contributing, paying that room in your house, and they're going to move with you in the new house, that is called boarding income. We can utilize that to help you qualify for more. We just need to have proof that that person has been renting and paying you rent for over a year, and we can use that. We can also use ADU rental income as well. And if you're buying a duplex, we can use, rental income for the second unit. All right. Any other questions? Did I miss anyone? I think I've got everyone already. Well, thank you guys for joining. It is 7:12. I will be here for another 5 minutes if you have any other questions. If you are interested in joining in our boot camp, so you learn more in depth about everything from home insurance to estimates to home warranty to PMI to contracts, initial deposits, going through pretty much a home buyer handbook, together, let me know. We will start opening up registry and about hopefully a couple of days. It will be posted already in our webinar. But if you are interested, send me an email. If you want to start applying for a home loan, you can just go online to our website and apply there directly, or you can download our app. Everything is secure. You can start uploading your documents. We will send you a checklist of items that we need. Typically, it's your W-2s and your pay stub, and it will provide it to you. So when you're online, it'll show you your tasks that are pending, which is, your pay stubs, your W-2s, or your self-employed, your taxes. If you are not ready yet and you want to buy in 3 months, 6 months, or a year from now, this is where you want to start. So it's never too early. This is a good practice. We are not going to run a hard inquiry. We're only going to do a soft pull. And we can do a free evaluation. There's no fee for that. So we can schedule a phone call with you afterwards to go over what you could be approved for now, what you could be approved for in the future, what are some steps that you could do to eliminate, to, qualify for more. If you want to work with an agent, so they can go through the buying process, we can refer someone to you depending on the area you're in. With no obligations, we know that education comes first with the clients, and then, we go through the process afterwards. So we're here to help you. Please, don't be shy. Send us a message. We love to, check in with you and see how we can assist. For the pre-approval, it's a hard credit check. No, we're running a soft pull only right now for the consultations, and we are issuing pre-approval letters with the soft pull. Once an escrow is opened, we would do a hard inquiry. Did you mention, currently we have an option to qualify for the first responder? Yes, you do. So the GSFA program, that's typically for the first responder teachers, it's available right now for everybody until the end of August. So if you're interested in the grant loan program, this is when you want to submit your application. If you have an application currently with us and you are interested in that, just send us an email and we will revise your pre-approval letter. Is it better to choose a local lender? Well, it's up to you. We service all of California. It doesn't matter where the lender is at. If you are happy with their services, it doesn't matter. But, if you want someone that you can walk into their branch, then definitely, right? And I'm in Downey, I'm in the LA County. We service clients all the way to Eureka, San Diego, you name it. We finance loans all over California, even out of state. So, but I do have some clients that want to walk in. And, if you're up north, that's not going to be possible. If you are, want a referral to a branch that's local to you, let me know. if that's what you like to do, to have an in-person appointment, and we'll see who we can match you with, because we are a nationwide company and we have a lot of branches all over California as well. So we'd be more than happy to match you with someone in person. But no, I think all lenders can lend anywhere in California or out of state. All right, let me see. Would I recommend a pre-approval to learn what programs we qualify for? Absolutely. Absolutely. Because, there's a lot of information online about programs, and, it's a lot of info that you're looking at and you're like, do I fit into that program? Am I qualified in that program? And that's our job. This is what we have experience in doing. This is what we do. Once we have an application in, we'll be able to determine what you're approved for, provide you some estimates, provide you some options, and you would be surprised that you're probably ready to purchase sooner than later. So definitely, and there's no commitment. Pre-approval doesn't mean you need to buy right away, but it does give you the opportunity to know what your financial situation is now and how quickly you can become a homeowner by preparing yourself. So it's never too early to start preparing to becoming a homeowner, because it does take time. Some of us are ready and some of us need a little bit of, hand-holding through the process and learning more about different options. Okay. Thank you guys so much. So we love to see you again. My boot camp's going to be amazing. It's probably going to be, your head's going to spin when we talk about numbers and closing costs, but I can assure you that once you go through that and you buy your home, the lending part of it's going to be out of the way, and the lending part's going to be really easy. And even the buying part, because you're going to have all these, unanswered questions already done. So as you go through that process, you're not going to have the bad experience, right? So the goal to the boot camp is that you have an awesome experience when you become a homeowner, from the lending perspective to the buying part of it. Okay. And I will have a special guest coming in, like insurance agents who are going to talk a little bit about, just like 10 minutes about insurances, what you should look for. I will also have a special guest, an agent, to come in and talk about contracts and contingency periods. So all these questions will be answered prior to you shopping for a home. Okay. So hope to see you guys there. You can send me an email if you want me to register. We're going to start our, promotion on that in the upcoming, weeks. And we're also going to have an offer after we're done with the boot camp. It's 3 sessions, 30 minutes each. And it will be, having an opportunity for our clients to have discounted fees as well if they work with us, American Pacific Mortgage. But there's a lot to learn. So hopefully we see you guys there. All right. Any other questions, anyone? If not, thank you guys so much for joining on a weekday. I appreciate you and hope that we stay in touch. Any questions, feel free to email me, okay? Thank you. Bye-bye.